Welcome back, everyone. Asset protection is one of the core pillars of the Wealthlocity product range. Today, we want to shed light on the mistakes that both beginners and supposedly advanced users make in their asset protection strategies, and how you can avoid them for yourself. This is Wealthlocity. Here you create, protect, and grow your wealth fast. Head in the sand. It'll be fine, or I have so little it's not worth it yet are often approaches that are found among those who have relatively recently acquired a, often still small, fortune. It is a misconception that someone who does nothing is also doing nothing wrong. Even the first small steps to secure even just part of your assets are still better than hoping that everyone is friendly to you. Spill the beans. Don't tell your best friend what you don't want your worst enemy to know. This is the principle of asset protection, because once you have said something, you cannot recall it. And if your best friend, spouse, relative, or business partner suddenly becomes your enemy, ex-partner, or competitor, you often have to quickly and expensively change your asset protection setup to deal with the changed situation. No matter how much trust you have in those around you, there is always room for that one account, that one safe deposit box, or that one offshore company that no one else knows about but you. In addition to changing loyalty, you also make yourself interesting to the wrong people if you chat openly about how you protect your assets, because talking about such measures often leads others to assume that you have more assets than you actually have, and maybe one or two contacts then come up with stupid ideas. One solution for everything. In asset protection, there is rarely a standard solution that can be completely applied to your own situation. Every asset is individual and exposed to different risks. A strategy that protects assets from the tax office and its taxes is often ineffective against sneaky heirs, or one that keeps the future ex-spouse in check does not protect against litigious competitors. Using such a standard solution often gives you a false sense of security. Using a sledgehammer to crack a nut. The internet and most advisory services are full of supposedly safe and at the same time overpriced offers. Even if a certain strategy protects assets effectively, it is often too large compared to the value of the assets to be protected. For example, it rarely makes sense to protect assets under $1 million with a foundation, which costs a lot to maintain each year. Many of the multi-level offshore holding structures sold are unnecessarily complex for small assets and bring compliance service providers, lawyers, and tax advisors a solid income every year at the expense of their own assets. It is precisely these kinds of strategists that require an asset protection strategy. Otherwise, the assets will quickly be eaten up by operating costs. Use outdated solutions. I read something about Panama in the newspaper. Is how consultations often begin. Since the Panama Papers, it has been clear to consultants that you can no longer lure anyone out of their shell with an offshore company in Panama, at least from a tax perspective. But customers cannot assess these things and ask about things that they know from the newspaper, TV, or for younger people, from some financial influencer. The basic principle is, if it was in the Build newspaper, it is off the table as a solution for a while. Build something yourself using the modular system. People who have just acquired wealth are often surprised by the costs of consulting and implementing asset protection services, and think it is a good idea to simply do some of it themselves in order to save costs. What may be a valid strategy when building a house, such as laying the parquet flooring in the living room yourself, can quickly backfire when it comes to asset protection, and not just as a beginner. Was the offshore company founded in the wrong country? Is the foundation statute illegal? Or is the supposedly secret account subject to data exchange? The damage quickly exceeds the costs saved for an expert. Correcting such beginners' mistakes afterwards is often more expensive than if you had it done as a complete package right from the start. Confusing asset management and asset protection. Asset management is there to make sure your money increases, while asset protection is there to make sure it doesn't decrease. Asset advisors and asset managers often also include the topic of asset protection, even if it is not a core focus, but rather serves to appear broadly positioned to the outside world. In most cases, it is a good idea for asset management and asset protection to be carried out by separate people or companies, as there can certainly be a conflict of interest between these two issues. This also protects against the next mistake. The asset protector has account access or power of attorney. While it is often common for asset managers to have access to accounts and company structures in order to make financial decisions on behalf of their clients, an asset protector should never have access to accounts or powers of attorney in companies, because asset protection ultimately means protecting the assets from the asset protector. The asset protector in particular enjoys special trust, as he knows all the internal details of his own setup, and therefore, of course, also all the remaining weak points from which a trusted person could enrich himself. Making the asset protector a trusted person with access here is literally putting the fox in the henhouse. Whenever an asset protection specialist asks for such access rights, all alarm bells should ring. Relying on so-called secret knowledge. All structures recommended by an asset protection expert should be verified by uninvolved third parties, such as a lawyer, tax advisor, or auditor. Requests from the expert not to discuss the structure with third parties should be treated with caution. Of course, a balance should be found here between don't spill the beans and get a second opinion. Only if you choose structures that are outside the legal framework should you think carefully about whether you want to share them with lawyers or government representatives. Fire and forget. Setting up an asset protection strategy once and then never questioning it again will sooner or later lead to difficulties. Either laws, family composition, or business connections change, and the old structure no longer fits your current wishes. A good rule of thumb is to critically question your own strategy once a year and adapt it to the new requirements. Wait until it's too late. If the divorce has been filed, the lawsuit has been received, or you are on your last journey to the hospital, it is often too late to save anything in a hurry. Maybe you can quickly hide a suitcase of money or a few gold bars somewhere, but then there is no time left for the big picture. As with health, prevention is the best way here. That is, start protecting assets when there is no acute risk. Not arranging asset succession. While you may want to protect your assets from greedy family members during your lifetime, you want them to benefit from them again after your death. However, written wills often do not fit in with the rest of the asset protection structure. To ensure that assets are not suddenly irretrievably lost, because no heir can access the structure, understand it, or even know that it exists, detailed records should be available and appropriate testamentary provisions should be tailored to the structure with the help of a lawyer. Losing track. The records mentioned in the previous paragraph are also extremely important during your own lifetime. It's easy to forget a foreign company, an account, or a safe deposit box. A basic recommendation in almost every Wealthlocity consultation on the subject of asset protection is to make them as fine-grained as if you had to retrain yourself after a complete bout of amnesia. This includes making sure that this documentation can be found even if you forget where you put it. Solutions to this include data safes or keys distributed to trusted people. A system that relies on trust. Contrary to a bank's web slogan, trust in asset protection is not the beginning, but sometimes the end of everything. In every place where a trusted person is needed, there is a person who can be compromised with the right incentive. Believing your own structure to be infallible. Have you spent a lot of money to create the ultimate asset protection structure? Then it is now time to spend even more money and hire someone to hack it. As in IT, there are so-called white hat hackers in the area of asset protection who try to undermine the structure on their own behalf and somehow gain access to the assets. They then share all possible attack vectors, and in the worst case, successful access, and improvements can be made. If you just avoid these 15 mistakes, your asset protection is already above average. Which mistake do you think is the worst one regarding asset protection? Let us know in the comments, and we see you in the next video with more money in your pocket.